Welcome back. Take a look at your screen right now as we pull up the tape for Opendoor Technologies, ticker OPEN. We are sitting around a heavily contested price zone that retail participants love to dismiss as a low-dollar speculative lottery ticket. Social media feeds are flooded with polarizing takes. One camp screams that digital iBuying is a dead structural experiment left over from the Zillow offer era, while the other treats every fractional green candle as a sign of an impending short squeeze that will launch the stock back to its pandemic-era highs. But while the retail crowd argues over whether housing affordability is completely frozen or if mortgage rates are going to tick down another 20 basis points, Wall Street's systematic desks are looking at something entirely different. They aren't looking at real estate as a collection of houses. They are looking at Opendoor as a high-frequency inventory management engine operating inside the most illiquid asset class on Earth. Here is the hidden structural reality that standard financial media completely misses. Traditional real estate is an archaic, friction-heavy market where the average transaction takes 60 to 90 days, choking off capital velocity. Opendoor's core innovation isn't just letting someone sell their house via a smartphone app with a few clicks. It is the creation of an algorithmic liquidity buffer. Think of it like a market maker in equity options or high-yield bonds, but instead of trading liquid contracts, Opendoor is market-making single-family residential real estate. The physics bottleneck here isn't optical interconnects or silicon thermal limits. It is inventory velocity, adverse selection risk, and home price index volatility. When macro volatility spikes, mortgage rates gap higher, and housing turnover seizes up, a traditional iBuyer faces catastrophic inventory holding costs, margin compression, and severe write-downs on balance sheet assets. Yet retail investors and mainstream commentators completely misunderstand how structural pricing models adapt during normalization cycles. They see a fluctuating net loss per quarter and assume the business model is inherently broken, ignoring the fact that Opendoor is aggressively refining its automated underwriting algorithms to dynamically adjust bid spreads. When liquidity dries up, Opendoor widens its fee spreads to protect against downside tail risk. They charge the homeowner for the immediate liquidity premium. When the market thaws, volume scales. The mispricing in Open today stems entirely from the market treating a cyclical liquidity provider as a structurally insolvent entity, completely overlooking the leverage inherent in their platform when transaction volumes eventually normalize across the American Sunbelt in suburban corridors. Let's pull back the curtain on how Open actually trades on a day-to-day basis, because the tape tells a masterclass story of institutional accumulation versus retail emotional fatigue. If you watch the intraday order book, you'll notice distinct algorithmic footprints. During morning sessions, retail traders armed with retail brokerage apps chase momentum spikes triggered by minor macroeconomic data releases, housing starts reports, or fleeting social media mentions. They buy the local top, and within hours, algorithmic block trades step in to cap the upside, initiating a slow, methodical bleed throughout the afternoon session. This systematic downward pressure isn't a sign of institutional abandonment. It is the classic anatomy of quiet accumulation. Institutional heavyweights, macro funds, and specialized quant shops know that a low-float, high-beta name will trigger stop losses and shake out impatient retail capital with surgical precision. Notice how volume dries up significantly during consolidation phases, only to experience sharp, institutional-sized volume spikes on days when the broader market indexes test macro support. Think about your own positioning right now. Are you sitting on the sidelines, nursing losses from previous cycles, waiting for a confirmed breakout above key moving averages, or are you actively scaling into tranches during these quiet, low-conviction consolidation weeks? Drop your current average cost or your execution strategy in the comments below. Let's see how this community is actually playing the tape. To truly understand where Open is heading, we have to strip away the outdated historical framing that haunts the company from its 2021 Special Purpose Acquisition Company, SPAC, and the subsequent pandemic real estate mania. Back then, financial media and Wall Street analysts crammed Opendoor into a simplistic, flawed narrative. They called it a tech-enabled house flipper, lumping it in with legacy home builders and traditional brick-and-mortar brokerages. That comparison is fundamentally wrong and misses the entire engineering architecture of the business. Opendoor is not in the business of speculating on long-term home appreciation. They do not buy houses hoping to sit on them for 5 years while the neighborhood gentrifies. Their entire operational model is designed around velocity, risk mitigation, and transaction throughput. At its core, the business operates through 3 primary segments: the direct-to-consumer iBuying marketplace, strategic partnerships with traditional brokerages and home builders who need a guaranteed liquidity exit for their buyers, and ancillary services, including title, escrow, and home financing integration. When a seller requests an offer through Opendoor, proprietary automated valuation models, AVMs, ingest thousands of hyperlocal data points, recent comparable sales, neighborhood foot traffic, school district ratings, micro-topography, and structural wear and tear indicators to price the home instantly. The goal is to turn inventory over in under 90 days, capturing a predictable service charge and ancillary fee revenue while minimizing holding period exposure to interest rate shocks. By viewing Opendoor through the lens of a fintech logistics platform rather than an old-world real estate brokerage, the historical baggage of the Zillow offer exit and pandemic-era inventory overexpansion melts away. The company survived the brutal 2022-2023 Federal Reserve rate hiking cycle, restructured its cost basis, slashed overhead, and emerged with a leaner, more resilient software-driven operational framework built to scale efficiently when monetary policy shifts in their favor. Looking out over the multi-year horizon, Opendoor sits at the intersection of several powerful structural tailwinds and very real operational hazards. On the catalyst side, the eventual secular normalization of mortgage rates and the pent-up demand across American demographics represent massive multi-year growth vectors. Millions of households are currently locked into low-rate mortgages, creating a phenomenon known as the lock-in effect that has paralyzed housing turnover. As families inevitably outgrow their homes due to life changes, growing families, job relocations, or retirements, they will be forced to re-enter the market. When transaction volume unfreezes, platforms that can offer absolute certainty, zero-hassle closing timelines, and instant liquidity will capture disproportionate market share. Furthermore, Opendoor's integration into traditional homebuilder ecosystems allows builders to offer seamless trade-in programs to prospective buyers, turning a massive structural bottleneck into a predictable B2B customer acquisition channel. However, an objective analyst must weigh these massive upside optionalities against clear, persistent risks. The macroeconomic environment remains a double-edged sword. Any unexpected spike in long-term treasury yields or sticky inflation prints can instantly freeze housing affordability, compress gross margins, and force inventory write-downs. Geopolitical and fiscal uncertainties continue to inject volatility into broader capital markets, impacting risk appetite for high-beta equities. Moreover, capital expenditure cycles and credit facility availability are critical lifeblood for iBuyers. Maintaining robust debt financing structures with favorable covenants is essential to fund inventory acquisition without diluting equity shareholders. Ultimately, retail investors get trapped in the daily emotional turbulence of short-term price noise, panicking over every single-digit percentage swing, while institutional participants focus on the long-term structural inevitability of digital transformation in multi-trillion-dollar analog industries. Real estate is the largest asset class on the planet, yet it remains one of the last to be fully digitized, automated, and optimized for instant transactional velocity. Companies that survive the valley of death during high-rate macro cycles often emerge as monopolistic gatekeepers when the economic tide turns. Look past the daily price noise, focus on inventory health in unit economics, and always maintain a clear-eyed perspective on the long-term thesis.